On October 15, 2025, the Reserve Bank of India completed a transaction that received almost no attention in Western financial media. The institution reduced its holdings of United States Treasury securities by approximately $50 billion over a 12-month period, marking a 21% decline in exposure to American sovereign debt. The timing of this liquidation is what transforms a routine portfolio adjustment into a structural warning. During the same period, yields on 10-year Treasury bonds range between 4.0 and 4.8%, representing some of the most attractive nominal returns available in developed debt markets in over 15 years. Under every conventional framework of reserve management, high yields attract capital. Central banks compete to lock in elevated rates when safe assets offer premium returns. The Reserve Bank of India did the opposite. This inversion of expected behavior reveals something far more consequential than a tactical reallocation. It demonstrates that one of the world's most conservative monetary authorities has begun pricing in a risk that does not yet appear in derivative markets, credit default swaps, or Federal Reserve dot plots. The risk being priced is not cyclical recession or temporary political dysfunction. It is the possibility that the United States has entered a debt trajectory from which there is no mathematical exit that does not involve either explicit default or the functional equivalent through monetary debasement. To understand why this matters, you must first understand what it means when a reserve manager sells a high-yielding safe asset. Reserve managers operate under a mandate that prioritizes capital preservation above all else. Their objective is not profit maximization, it is loss avoidance. When such an institution liquidates a position during a period of attractive returns, it signals that the perceived safety of the asset has fundamentally changed. History provides clear precedents for this type of behavior. In 1931, the Bank of France began quietly liquidating its holdings of British pound sterling, even as the Bank of England maintained official gold convertibility and offered competitive interest rates. The French central bank had concluded, correctly, that Britain's fiscal position was unsustainable and that the gold standard peg would eventually break. 6 months later, Britain abandoned gold convertibility, and French reserve managers had protected their nation's wealth by exiting early. The pattern repeated in 1971 when several European central banks, most notably the Bundesbank, accelerated their redemptions of dollars for gold in the months preceding Nixon's closure of the gold window. These institutions detected the same warning signs that are visible today: a nation running persistent deficits, while simultaneously expanding military commitments and domestic obligations. Foreign creditors providing the financing necessary to sustain both, and a political system incapable of making the fiscal adjustments required to close the gap. The mathematics of the current American fiscal position are not speculative. They are documented in Treasury Department releases and Congressional Budget Office projections. The United States currently carries approximately $38.5 trillion in acknowledged federal debt. Annual interest payments on this debt surpassed $1 trillion in 2024 and are projected to exceed $1.2 trillion by 2026. This interest expense now represents the second largest line item in the federal budget, trailing only Social Security and exceeding defense spending. The trap is structural. As debt levels rise, interest costs rise. As interest costs rise, the deficit widens. As the deficit widens, the Treasury must issue more debt. As more debt is issued, the market demands higher yields to absorb the supply. Higher yields increase interest costs, and the cycle accelerates. This is not a moral judgment about government spending. It is a description of a compounding function that operates independently of political ideology. The current trajectory requires the United States to find buyers for approximately $2 trillion in new debt issuance annually, not including the rollover of maturing securities. For the past 4 decades, this demand has been met primarily by foreign central banks, particularly those in East Asia and the Middle East, who recycled their trade surpluses into dollar-denominated assets. This arrangement functioned as the operational backbone of the post-Bretton Woods monetary system. Exporting nations accumulated dollars, which they then returned to American debt markets, suppressing yields and financing consumption. The system relied on a single assumption that could never be explicitly stated but had to be universally believed. The assumption was that the United States would never allow inflation to erode the real value of its obligations and would always prioritize the interests of its creditors over the short-term preferences of its electorate. That assumption is now being tested, and the Reserve Bank of India's liquidation suggests that the test is failing. When foreign holders of United States debt reduce their exposure during a high-yield environment, they are indicating that nominal returns no longer compensate for the perceived risk of capital destruction through either outright default or currency devaluation. This is the signal that precedes every sovereign debt crisis in recorded economic history. The pattern is consistent across centuries and continents. Creditors begin withdrawing quietly while official statements remain reassuring. Yields rise, not because growth expectations improve, but because risk premiums expand. And the debtor nation, rather than adjusting its fiscal policy, doubles down on the belief that its currency's reserve status exempts it from the constraints that bind ordinary borrowers. This belief has never survived contact with arithmetic. The situation is compounded by what is occurring simultaneously in China, where monetary policy has diverged completely from the Western model. While real estate valuations in major Chinese cities have declined by 20 to 25% since their 2021 peaks, the money supply has expanded to approximately $48 trillion in M2 terms, more than double the comparable figure for the United States. This creates an apparent contradiction. If the Chinese economy is contracting, why is the money supply expanding so aggressively? The answer reveals a fundamental difference in how the two systems deploy liquidity. When the United States Federal Reserve expands the money supply, the liquidity flows primarily into financial assets. It supports equity valuations, compresses credit spreads, and enables corporate debt issuance. This creates wealth effects for asset holders, but does not meaningfully alter the productive capacity of the underlying economy. It is money chasing existing assets, rather than money creating new assets. The Chinese model operates differently. The $48 trillion in broad money supply is being directed into physical infrastructure, manufacturing capacity, and resource acquisition. The real estate correction is not being resisted. It is being allowed to proceed because cheaper property reduces the cost base for industrial production. Capital that would have been trapped in speculative residential developments is instead being channeled into battery manufacturing plants, high-voltage transmission infrastructure, and strategic mineral extraction operations across Africa and South America. This divergence explains why China is no longer recycling its trade surplus into United States Treasury securities. For 2 decades, Chinese institutions purchased American debt as a mechanism to prevent their currency from appreciating too rapidly against the dollar, which would have harmed export competitiveness. That strategy is no longer operational. China is now using its surplus dollars to acquire physical commodities, energy resources, and production facilities. The dollars are being spent, not saved. This represents a structural shift in global capital flows that has not yet been fully absorbed by Western debt markets. The demand side of the equation for United States treasuries is collapsing at precisely the moment when the supply side is accelerating. The confluence of Indian liquidation and Chinese redirection creates a pincer movement against dollar-denominated debt. On one side, demand is falling as major holders exit. On the other side, supply is rising as fiscal deficits widen. The natural equilibrium response in any market is a price adjustment. In bond markets, price and yield move inversely. If demand falls and supply rises, prices must decline, which means yields must increase. The question facing the Federal Reserve is how high yields must rise before domestic demand is sufficient to absorb the supply that foreign buyers are no longer purchasing. Every percentage point increase in yields adds hundreds of billions of dollars to annual interest costs, which widens the deficit further and requires even more debt issuance. This is the definition of an unstable equilibrium. Historical precedent suggests that reserve currency transitions do not occur through formal announcements or policy declarations. They occur through incremental portfolio adjustments that accumulate over years until a threshold is crossed and the system reorganizes around a new anchor. The British pound remained the dominant reserve currency for nearly 2 decades after Britain's fiscal position had deteriorated beyond sustainability. The transition to dollar dominance was not completed until the 1950s, long after the economic fundamentals had shifted. But once the transition reached critical mass, it accelerated rapidly. Central banks that hesitated to diversify found themselves holding devalued assets, and those that moved early preserved their purchasing power. The Reserve Bank of India's action is consistent with early-stage diversification in advance of a currency transition. The $50 billion that left the Treasury market did not rotate into euros or yen, both of which face similar structural challenges. The capital moved into gold. This is significant because gold represents the only reserve asset with no counterparty risk. It cannot be printed, defaulted on, or devalued through policy decisions. For most of the past 40 years, gold comprised a static and relatively small portion of central bank reserves, generally below 15%. That ratio has been rising steadily since 2018 and accelerated sharply in 2024. In India's case, gold now represents a larger share of total reserves than at any point in the previous 2 decades. This is not an isolated anomaly. Russia, China, Turkey, and several other nations have followed similar trajectories. The shift toward gold accumulation by sovereign reserve managers signals a loss of confidence not in any single currency, but in the fiat currency system itself. When central banks diversify away from dollars into euros or yen, they are expressing a preference for one liability over another. When they diversify into gold, they are expressing a preference for assets over liabilities. This distinction is critical. It suggests that the institutions responsible for managing national wealth have concluded that the risk of holding paper promises now exceeds the convenience yield those promises provide. The convenience yield of holding dollars includes access to deep capital markets, ease of transaction settlement, and geopolitical alignment with American power. For decades, these benefits outweighed the risks. That calculation is now reversing. The current structure contains no mechanism for self-correction. The political system in the United States is not capable of generating the fiscal surpluses necessary to stabilize the debt-to-GDP ratio. Both major political coalitions have constituencies that depend on sustained government expenditure, and neither has demonstrated willingness to impose the economic pain required for fiscal consolidation. The Federal Reserve cannot sustainably suppress yields through asset purchases without reigniting inflation, which would accelerate the foreign exodus from dollar-denominated assets. And the Treasury cannot reduce borrowing without triggering immediate economic contraction, which would reduce tax revenues and widen deficits through automatic stabilizers. Every available policy response creates a secondary problem that is worse than the one it solves. What remains is a slow, then sudden process of adjustment. Foreign holders will continue reducing exposure incrementally, applying steady upward pressure on yields. Domestic buyers will demand higher risk premiums to compensate for currency and inflation risk. The Federal Reserve will be forced to choose between allowing yields to rise, which destabilizes the debt arithmetic, or intervening to cap yields, which destabilizes the currency. Both paths lead to the same destination: a reset of the system in which either the debt is restructured or the currency is debased. History suggests the latter is more politically feasible. Governments default through inflation far more often than they default explicitly. The Reserve Bank of India's liquidation indicates that sophisticated reserve managers have already begun positioning for this outcome. The question is not whether the adjustment occurs. The question is whether institutions and individuals will recognize the pattern before the threshold is crossed, or whether they will continue to believe that this time is different until the moment the market proves otherwise. The specific mechanism through which this transition manifests can be observed in a single chart that has received almost no analytical attention outside specialized reserve management circles. Between 2006 and 2018, the composition of India's foreign exchange reserves followed a predictable pattern. Dollar-denominated assets, primarily United States Treasury securities, represented approximately 65 to 70% of total holdings. Gold comprised roughly 8 to 12%, functioning as a legacy asset with no active management strategy. The remaining balance was distributed across euros, yen, and special drawing rights. This allocation was standard across most emerging market central banks and reflected the implicit hierarchy of the post-1971 monetary system. Dollars were the foundation. Everything else was supplementary. The inflection point occurred in 2018, though it was not recognized as such at the time. Gold holdings began a steady, uninterrupted ascent as a percentage of total reserves. By 2022, gold had reached 20% of India's reserve portfolio. By 2024, it had crossed 25%. And as of the most recent data available from late 2025, gold now represents approximately 30% of total reserves, while dollar-denominated holdings have declined to roughly 48%. This represents a complete inversion of the traditional reserve hierarchy within a single decade. The asset that was once a historical relic is now approaching parity with the asset that was once considered untouchable. What makes this transition structurally significant is not the absolute quantity of gold being purchased, though that figure is substantial. What matters is the rate of change and the coordination across multiple sovereign actors. Russia provides the most extreme example of this reorientation. Following the imposition of financial sanctions in 2014, the Central Bank of Russia began systematically liquidating dollar assets and accumulating gold at a pace that had no precedent in modern central banking. Between 2014 and 2021, Russian gold reserves increased from approximately 1,000 metric tons to over 2,300 metric tons, while holdings of United States Treasury securities declined from $130 billion to effectively zero. When additional sanctions were imposed in 2022 and Russian dollar reserves held in Western financial institutions were frozen, the lesson was transmitted to every other central bank operating outside the Western alliance structure. The lesson was that dollar reserves are not neutral stores of value. They are political instruments that can be weaponized or confiscated under conditions that may have nothing to do with the economic policies of the holder. China's response has been more gradual, but equally definitive. Official gold reserves reported by the People's Bank of China have increased from approximately 1,000 metric tons in 2015 to over 2,200 metric tons as of 2025. However, multiple analysts who track physical gold flows through Hong Kong, Shanghai, and London bullion markets estimate that actual Chinese state accumulation, including purchases made through non-transparent vehicles, may be significantly higher. potentially exceeding 4,000 metric tons. The discrepancy between official reporting and physical flows suggests that China is deliberately understating its gold position to avoid signaling its intentions too clearly before the accumulation phase is complete. This behavior is consistent with strategic resource acquisition across other commodities. China does not announce its moves, it completes them, then acknowledge them retroactively once the market has already adjusted. Turkey, Poland, Hungary, and several other nations have followed similar trajectories, each increasing gold reserves as a percentage of total holdings while reducing dollar exposure. The pattern is consistent across geographies and political systems. What unites these actions is not ideology, but arithmetic. These institutions have calculated that the probability-weighted return on holding dollars, accounting for currency devaluation risk, inflation risk, and confiscation risk, no longer justifies the allocation. They are not betting against the dollar in the speculative sense. They are rebalancing away from it in the actuarial sense. The distinction is critical. Speculators bet on volatility and reversals. Reserve managers rebalance based on permanent shifts in underlying risk parameters. The significance of gold in this context is that it represents the only form of reserve asset that exists outside the banking system entirely. Dollar reserves are claims on the Federal Reserve. Euro reserves are claims on the European Central Bank. Even special drawing rights are synthetic instruments that derive their value from a basket of fiat currencies. Gold is the only asset on a central bank balance sheet that has no counterparty. It cannot be printed into existence by a foreign government. It cannot be frozen by executive order. It cannot be diluted through monetary expansion. These properties make it uniquely suited to an environment in which trust in institutional promises is declining and the risk of systemic dislocation is rising. This is not a return to the gold standard in any formal sense. No nation is proposing fixed exchange rates or convertibility requirements. What is occurring instead is a market-driven repricing of gold's role as the ultimate settlement asset between sovereigns. The repricing mechanism operates through a feedback loop that is now visible in both reserve composition data and market pricing. As central banks increase their gold purchases, they reduce the available supply in the physical market, which places upward pressure on the price. As the price rises, gold becomes a larger percentage of existing reserve portfolios even without additional purchases, which reinforces the perception that gold is gaining monetary importance. As that perception spreads, additional central banks initiate or accelerate their own accumulation programs to avoid being left behind in a currency transition. And as more institutions move in the same direction, the probability that the transition reaches a critical threshold increases, which validates the initial decision to diversify. This is how currency regimes change, not through conferences or treaties, but through distributed decisions that align around a common recognition that the existing arrangement is no longer stable. The velocity of change is accelerating. In the 2 decades between 1980 and 2000, global central bank gold reserves were essentially flat, hovering around 30,000 metric tons. Central banks were net sellers during this period, disposing of gold they considered obsolete in a world of floating exchange rates and sophisticated financial markets. Between 2000 and 2010, the selling slowed but continued. Since 2010, central banks have been net buyers every single year, with annual purchases increasing from approximately 400 metric tons in 2010 to over 1,000 metric tons in 2022 and 2023. The institutions that spent 2 decades declaring gold irrelevant have spent the last decade acquiring it as fast as the market can supply it. This reversal did not occur because central bankers suddenly became sentimental about historical monetary systems. It occurred because the mathematics of sovereign debt in developed economies made it clear that fiat currency reserves were no longer offering adequate protection against systemic risk. The United States holds approximately 8,100 metric tons of gold in official reserves, representing the largest sovereign holding in the world. This position has remained essentially unchanged since the 1970s. The assumption embedded in American monetary policy is that this static holding is sufficient because the dollar itself functions as the reserve asset, making additional gold accumulation unnecessary. This assumption worked as long as foreign central banks agreed to accumulate dollars instead of gold. But when those same institutions begin rotating out of dollars and into gold, the static American position becomes a strategic vulnerability. The United States is not competing in the accumulation race that is now underway. It is watching from the sidelines, while potential adversaries and nominal allies alike build positions that could, in aggregate, exceed American holdings within the next decade if current trajectories continue. The implications extend beyond the balance sheets of central banks. When sovereign institutions signal through their portfolio allocations that they no longer trust the long-term purchasing power of the dollar, that signal propagates through every level of the financial system. Pension funds begin questioning their assumptions about risk-free rates. Insurance companies revise their liability matching strategies. Corporations reconsider the denomination of their cash holdings. And individuals, particularly those in emerging markets who have experienced currency crises before, begin converting savings into harder assets. This is not speculation or panic. It is rational behavior in response to observable changes in the structure of the monetary system. The process is self-reinforcing because each layer of the system that diversifies away from dollars increases the pressure on the remaining holders, making their positions less stable and more urgent to exit. There's a specific historical analog that demonstrates how this dynamic unfolds in real time. In 1929, the French franc was pegged to gold at a rate that significantly undervalued the currency relative to its purchasing power. This created persistent trade surpluses for France and corresponding deficits for gold standard countries like Britain and the United States. French authorities converted their dollar and sterling surpluses into gold, legally and systematically, draining reserves from other central banks. By 1931, the pressure had become unsustainable. Britain abandoned the gold standard in September. The United States held on for another 2 years, but was eventually forced to devalue the dollar against gold in 1933 and then prohibit private gold ownership to prevent further outflows. The system collapsed, not because of a military conflict or a political revolution, but because the arithmetic of reserve flows made the existing arrangement untenable. The countries that recognized the instability early and converted their paper claims into gold preserved their wealth. The countries that waited lost purchasing power when the devaluations occurred. The current situation differs in important ways from the 1930s, but the underlying mechanism is identical. A dominant reserve currency is being issued in quantities that exceed the willingness of foreign holders to accumulate it. Those holders are converting their surpluses into an asset that cannot be devalued through policy decisions. And the issuing nation is faced with a choice between fiscal adjustment, which is politically unacceptable, or monetary expansion, which accelerates the exit. The choice has already been made. The United States has selected monetary expansion over fiscal discipline in every crisis since 2008. The 2008 financial crisis was met with quantitative easing. The 2020 pandemic was met with multi-trillion-dollar deficits. The 2023 banking stress was met with emergency liquidity facilities. Each intervention successfully prevented immediate collapse, but did so by increasing the total debt burden and reducing confidence in the currency's long-term stability. The Reserve Bank of India's $50 billion liquidation is the market's verdict on that trade-off. What separates the current moment from previous warnings is the absence of any viable alternative reserve currency. In the 1930s, countries could shift from sterling to dollars or to gold. In the 1970s, they could shift from dollars to marks or yen or gold. Today, the euro is backed by a monetary union with deep structural flaws and negative demographic trends. The yen is issued by a nation with a debt-to-GDP ratio exceeding 250%. The renminbi is not freely convertible and remains subject to capital controls. There is no paper alternative to the dollar that offers greater stability. This creates a unique circumstance in which the flight from the dominant reserve currency cannot be redirected toward a competing currency. It can only be redirected toward non-currency assets. Gold is the most liquid and widely recognized of these assets, which explains why it is absorbing the majority of the flows exiting dollar reserves. The endgame of this process is not the collapse of the dollar in any dramatic sense. Reserve currencies do not disappear overnight. They decline over decades as their share of global trade invoicing and reserve holdings gradually diminishes. Sterling remained important for international settlement well into the 1960s, even though Britain's economic dominance had ended decades earlier. The dollar will likely follow a similar trajectory. It will remain the largest reserve currency for years, possibly decades, but its share will contract steadily as alternatives emerge, and as trust in American fiscal sustainability continues to erode. The nations that adjust their reserve portfolios early will preserve more purchasing power than those that wait. And the individuals who recognize this transition and position accordingly will be better insulated from the currency devaluation that becomes necessary when a debtor nation can no longer find willing creditors at acceptable interest rates. The mathematics are not speculative. The outcomes are not uncertain. What remains uncertain is only the timing and the magnitude of the adjustment. The Reserve Bank of India has provided its estimate through its actions. The question facing every other institution and individual is whether to accept that estimate or to wait for additional confirmation that may arrive only after the optimal exit point is passed.